All right, hi Lydia, great to have you on. I appreciate you being willing to put this out there because I think a lot of people are going to have very similar questions to you. I know you're living in Dubai now and starting a business, and I think maybe just give a general overview and background into your situation. We can dive into the specifics and some of the tax strategies around that to try and keep you compliant and do it tax efficiently.
So I'm an American and I've been living in Germany for the last 13 years. My spouse is German and we've just relocated to Dubai in July of last year. So I decided to go out on my own and start my own business. That was about September timeframe. So I have a background in communications, PR, and social media. And so I've started a small communications strategy and consultation company where I'm just working with clients remotely, ultimately, but in Dubai, where we are at, and also in the US. And I coach individuals on how to show up on social media. And I also work with companies in a more B2B setting to help marketers get the most out of what they're doing on social and online.
Fantastic. I guess you were doing this before, but you never did you have a US company set up before?
No, I'm completely new to self-employment. So I worked in big US corporation for the last 4 years. So I'm very new to all of this. Tax and whatnot is not my strong point. So everything you want to explain to me, feel free to explain it like I am a kindergartner because that's going to help me out.
The basic idea as a US citizen and being an expat is that you're subject to tax on your worldwide income. And so we need to report your worldwide income to the IRS. And then from there, it's a coordination effort to figure out, are you paying taxes on that same income in your local country as well? And what can we do about that? The good news with the UAE and Dubai is that there is no personal income tax. So that's not something we have to worry about. But then the question is, how do we best structure this from a US and local perspective? And you have a few options. I mean, if you do nothing and you just operate it personally, like you don't set up a US or a foreign company, the way that will work is you should be eligible for the foreign earned income exclusion. That has specific rules, but I mean, you basically have to be a bona fide resident of a foreign country for a full calendar year or be outside of the US for a 330 out of a 365 day period. In your case, you're clearly a bona fide resident outside the US. I don't worry about you meeting the requirements for foreign earned income exclusion. That's really the simplest answer, is that we exclude up to about $125,000 of your earned income, and that would include self-employment income. And so as long as you're under that, you're not paying US tax, but you still have to pay what's called US self-employment tax. So that's Social Security and Medicare. And I mean, on $120,000 or so, that could be $16,000 US dollars still. And with Dubai, some countries have what's called totalization agreements where you can get rid of the U.S. tax and claim to be on the foreign country system. The UAE is not one of those. I guess that's a simple answer for you, but we can go one step further with that. And if you set up a company in Dubai, a Dubai company, their version of the LLC, have you looked into the different forms of business?
Yeah, so similar. They do things a little bit differently here. It really depends on which emirate you're going to start your business in. For me, I started one in what's known as Sharjah. But ultimately, you can be self-employed or you can have a single shareholder LLC. And so that's what I've gone ahead and set up.
And that's a very common way to do it anywhere. Like if you're in the U.S., there's non-tax reasons for setting up these companies from a liability protection perspective. The thing that trips a lot of people up is that when you set up the foreign version, the non-US version of an LLC, it defaults to a foreign corporation. Whereas in the US, if you set up an LLC and you're the only owner, it defaults to a flow-through, meaning it's like it doesn't exist for tax purposes. The income and expenses flow to your personal US return and you pay taxes on it like that. When it's in a foreign corporation, you own 100% of it. That's going to be a controlled foreign corporation. That falls into, it can be a more complicated regime just because it can trigger an additional filing requirement in the US. But the general rule is when you own a foreign corporation, which this LLC would default to, you're not taxable in the US on the earnings of that until you pull it out as either a salary or a dividend. In that case, there is a concept of deferral in that if you don't pull the money out, it defers U.S. tax on that. the IRS has now anti-deferral rules, and one of them, the acronym is actually called GILTI, believe it or not. It stands for Global Intangible Low Taxed Income. But for a service-based business, without getting into all the details of that, it's going to apply to any service-based business that doesn't have a big fixed asset base. That requires you to pick up that net income today as ordinary income, regardless of whether you distribute it or pay it out or not. In general, it's more complicated and can be a bad idea, but in your case, the benefit of doing it this way is that you can have this foreign corporation, you can pay yourself a salary. So let's say it makes $100,000 or $50,000, and you pay yourself a salary of $50,000. That's going to be an expense to the business, so you're going to have no income at the business, so nothing's subject to this GILTI regime. You're going to pick up the salary in the U.S. We can claim a foreign earned income exclusion against it, and a salary from a foreign company is not subject to U.S. Social Security taxes. Unless you're doing work in the U.S., that can cause problems. But as long as you're working outside the U.S., the salary from that company, in that case, is if you're making under $125,000, you're not paying any tax at all. There is additional form requirement. You have to file a Form 5471 with your U.S. return, which is basically like a mini corporate tax return for the Dubai company. So that's kind of your best tax answer, and it is a little more complicated in that you have this additional form. You got to set up payroll in the local country. The other option is you can make an election to treat this LLC as a flow-through, like what happened by default in the U.S. And in that case, you don't have to set up salary. It's just going to flow through to you, and then you're back in the self-employment tax scenario. Those are kind of your options. I guess there's three. There's do nothing, and you're going to pay self-employment tax in the U.S., and we can claim the foreign earned income exclusion. We can have the foreign corporation, and you can set up a salary. It's a little more complicated, but we can avoid the self-employment tax altogether with a legitimate, employment agreement. And then there's the flow-through scenario.
It definitely sounds like the foreign corporation idea is probably going to be the best. But with this flow-through, you mentioned that we would need to get that set up. So how would we go about that process? And how different is that from just doing the additional form?
To do that, we would get the company a taxpayer ID number in the U.S., and that'd be with a Form SS4. And then that would allow us to make an election with Form 8832, treat or classify the company as a disregarded entity for U.S. tax purposes. And we can do that retroactive 75 days, or really you have technically until the filing due date of that year's tax return. So if you set it up in 24, we have until you file your 2024 return to make that election. And then going forward, there is an additional form for that one. It's a Form 8858 that you file with your U.S. return, just to show the profit and loss and a very basic balance sheet. But it's a lot simpler form than the 5471 for the foreign corporation.
What it sounds like right now is that actually the whole process for the flow through would be a more complicated process.
The startup is a little more complicated just because you have to make the election. But going forward, it's less complicated because it's just a flow through and a pretty simple form that you do every year. The corporation, I guess it can get a little more complicated. The form filing is more complicated. You have to get the employment agreement set up. And, if you start making more money, like let's say you go over that, at some point you have to be a little careful because there is kind of a reasonableness approach to the foreign corporation, in that if this company makes $200,000, at some point there is a risk of the IRS recharacterizing what we're calling a salary as a dividend. That's something you have to look at too, is in that employment agreement we have to kind of mark up, because how much of what you're getting paid is related to the services you're providing versus as an owner you're getting a distribution. And they're going to be taxed differently because that's where that GILTI piece will come in. So the part that's not related to your salary would not be eligible for the foreign earned income exclusion. With the flow through, it doesn't matter what you're paying yourself, you're having to pick it all up anyway.
If I can avoid, in a legal way, it makes sense to me. I want to take as much incentive and benefit as I can in that way. Now, the thing is, this right now is a side business. It's a part-time business for me. I'm not expecting to make a lot of money in the first 2 years. So 2024, I didn't. I had a tiny revenue, which, I'm very much so in the red. Now in 2025, I'm really not sure. Definitely not expecting to go above the threshold for FEIE. So do you recommend one or the other in my personal case? And I have already gotten help to create an employment contract locally for myself. So that's no problem on my side.
To me, it's always a balance between simplicity and tax saving. You know, like, I mean, you don't want to make something super complex just to save. There's a price to complexity, you know? But I guess one thing that I can do too is I can kind of show you in numbers, like model out the two options just so you can see what that looks like just from a numbers perspective, because it's kind of hard to visualize it. I mean, I do this all day, so it makes sense to me, but I can understand it's hard to kind of grasp what both looks like, the full picture. Like if I make $50,000 under both scenarios, what does that actually mean at the end of the day? And I guess kind of in simple terms, what that means is in the flow-through scenario, you're going to pay around 12% after a deduction for the self-employment tax. In the corporate scenario, you're going to pay, depends on what we set up your compensation as. I think it's a little aggressive to show all of your earnings as compensation and wipe it all out, except for maybe in the earlier years where there's less income. We can find a reasonable way at your income level to where you're not paying any tax, though, on the corporate scenario. To summarize that, in your case, since the company's already set up, the employment agreement's already in place, I would suggest going that route just because you've kind of done the hard part. It's going to be, your tax return will be a little bit more expensive doing that route, but I mean, you're saving a lot more than that additional fee by not having this employment tax.
Now, just because I really need to break this down for my understanding, I mean, let's say, because you're talking about earnings right now, I'm still in the red, you know, and my expenses are still absolutely higher than I'm not making a profit by any means.
Right.
So I guess the other question is it worth going down such a complicated route if I'm not truly earning money? I'm not making a profit.
Yeah, no, actually, that's a good point. I'm glad you mentioned that, because with the corporate route, one negative to that outside of the complexity is that you lose the benefit of prior year losses.
If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice.
Now, you might not need that because of the foreign earned income exclusion and the strategy we have with the salary. If you lose $10,000 this year and $2,000 next year, and then you start making money, generally you have like a net operating loss that's going to carry forward. Like in a flow-through scenario, you can apply those losses to income later. In the corporate scenario, this concept of GILTI and that anti-deferral rule doesn't allow that carry forward of losses. That can be a negative. I see that a lot, especially with people that have like rental properties in foreign corporations. That can be a huge disadvantage to the corporate scenario because rental properties notoriously have losses, mainly because of depreciation. So it's not a cash loss. But another way to look at it is the flow through. There's also a standard deduction in the US of up to $13,000 depending on the year. But I guess that doesn't apply to the self-employment tax. So for you, it's really going to be weighing the cost of the self-employment tax versus the complexity or simplicity. The self-employment tax isn't going to be a whole lot depending on your income. And that's one thing we could look at together is just we could kind of model out a what-if scenario over 3 to 5 years. So you lose money a couple years, then you start making money. What does that look like in the self-employment tax scenario versus the other scenario? So you can see what the tax looks like, and I can also like show you the fees associated with one or the other. I think that would give you what you need to make a better decision.
Absolutely. Because right now, I kind of, even though I'm not earning yet, I mean, I will be at some point. That's the whole point. And I'm curious. I mean, does that mean that I can change? Can I change the status? Can I go from filing one way to the other the next year? Or do I have to stick with whatever I choose?
Yeah, that's what I was going to mention is that it's hard to go from the corporate scenario to the flow through because it's treated as a liquidation event. If you set it up as a corporation and you want to treat it as a flow through, you have to make this election and it's a deemed liquidation of the company, which could, I mean, depending on the situation, that may not have a tax event depending on different factors, but that can be a little complicated. And then the other way, once you make an election under these entity classification rules, you can't make another election for 5 years. So if we make an election to treat it as a flow through, we have to wait 5 years before we could make it a corporation. You're kind of stuck in a way. You're not completely stuck, but
Yeah.
it's not easy to flip-flop back and forth. And the IRS kind of designed it that way just because they don't want you just going back and forth to whichever year it's more beneficial, So yeah, I mean, I think we can look at both options, but I think either one will work for you. I think the corporate scenario is going to you're going to pay less tax in that scenario, but the flow-through scenario is more simple. And it's more flexible in that it also depends on like where you think you're going to be. If you move somewhere else, it could make it, the corporate scenario could be, it's a little bit less flexible because if you want to move, for example, if you moved back to Germany and you don't want to keep this Dubai company, in the flow-through scenario, it's already not really a company. It's very easy for you to just take that out and put it in a German company or wherever. Whereas in the company scenario, there'd have to be a liquidation event, again, to close that business down and put it somewhere else. There may be some ways we could avoid actual tax on that transaction, but it's more complicated. So the flow-through is simpler filing and more flexibility. There's really no way to avoid the self-employment tax. I mean, there is a benefit to the self-employment tax in that you have to pay, 10 years to get your U.S. Social Security. I don't know if you're already there or not. Presumably, there's still going to be Social Security when we retire. I guess we'll see. But you may not be paying in for nothing. I can show you both options too, and we can kind of agree to some basic assumptions, a couple year period, and you can see it both ways, and then we can kind of make a decision. But we have time. Like, we can make that election. We just need to do it before you file your 24 return.
Okay, yeah, true. So we need to kind of be working on that, but yeah, there's a little bit of time there. And like I said, I had very minimal earnings, and my expenses very much so outnumber those earnings from last year. But it sounds like it's not really at this point about how much I'm earning. It's really just about more the strategy and the kind of the ultimate long-term vision I'm having for the company. I mean, I'll be honest, I'm leaning towards still setting it up, with
the corporate employment.
Yeah, because I'm kind of halfway there anyways, and I'd love to, start how I want to finish. But yeah, I think it has to be then a separate conversation where maybe we just really drill down into that.
We can get a little more detailed and specific. And I do think that that's probably a better route for you. I mean, obviously you plan on making money at some point.
Yeah. But I am realistic. It's not going to be quick.
And like the inflexibility part, it's not that inflexible in that, like, if we're taking the majority of the earnings out anyway every year, like as a salary, then, if you did move somewhere else, it's not that big of a deal to take the rest of the earnings out. There may be a tax hit on that. If there's even any left, we could plan for not leaving earnings in the company specifically for that reason. And then it's very easy to move to, you just set up another company somewhere and you can close down the UAE. I really think you've done kind of the harder part of the company side already.
And just from my understanding, when you say earnings, you're talking about any money I'm truly bringing into the company? Like, sorry, these are really pedantic questions. Okay. Oh, net earnings. Okay.
Yeah. When I say earnings, I mean like net of your expenses.
Okay. Because I was going to say, like, right now my expenses, way outnumber that. And then just because I am in the conversation on my side with getting that employment contract set up. Now, same thing, I need to set essentially a salary for myself, and I'm not able to pay myself that salary right now, but I need to get that employment contract in place. Is there anything from the U.S. side that I need to be aware of in terms of how much I'm paying myself?
How much is probably less important than terms of the employment contract, because there are specific definitions of what is considered an employee versus, say, a contractor. We want to make sure that it's an employment arrangement, but I can send you over some employment language that I think would be in there. But honestly, if it's an employment agreement that you have like a legal person setting up, then that it's most likely going to meet that definition. I'd be happy to review it just to be sure. And then as far as the amount, you could put something in there to where it's like at the discretion of the owner, at the end of the year. You kind of set it up as like compensation, like a bonus type arrangement, where at the end of the year, at the discretion of the owner, pay yourself a bonus based on the profitability of the company. You could set up something very small, a small salary subject to a bonus. Maybe that's a better way to do it.
Okay. Let's see, because right now it's a bit of a boilerplate, sorry, not boilerplate, it's a bit of a template from the state, from the emirate that I've set my business up with. They offer this as part of the business setup, that they'll do a sort of a standard employment contract for you. So I'm not sure how much flexibility is there with it. I'll look at that from my side. I wouldn't be penalized if I, say I'm going to pay myself a certain amount, but I don't, because ultimately I didn't earn it.
No, No, you wouldn't be penalized.
Okay.
I mean, the only risk you have in the U.S. with the employment agreement, why it's important, is just you don't want them to recharacterize it as a dividend if you do have it.
How much?
So, I mean, really, in a year where there's losses, you don't really need to set up the salary because there's nothing that the IRS could recharacterize, you know? So it's really just in a year that there's earnings, like, and when I say earn, I mean like net earnings, that it's even important.
That's good to know. I think I didn't realize that when I started that whole process with the agreement.
That's the important part, is because we just don't want the IRS to say if you pay yourself that it's considered a dividend.
Yeah.
Because I mean, you wouldn't have paid yourself at all, right? In this past year.
Exactly.
There's really nothing at risk in that sense because there wasn't anything paid.
Do I need to even go through this route for 2024, considering I made less than $500?
No, I don't think so. I think for 2024 you can leave it and you can put it in place. Because, I mean, you have a template, but, I mean, it's only a contract if you sign it, you know?
Okay, let's see, because right now it's
of the company. So, I mean, you can enforce that or, enact that agreement in 2025. It's not needed for a loss year.
okay. But in terms of just in general claiming, filing and claiming that I have a business or that I'm earning anything, I mean.
Yeah, we'll still need to do the Form 5471
Yeah.
and show the profit and loss statement and the balance sheet, but there's no income.
Okay. And then really another kind of pedantic question, but considering that here I'm not liable for taxes at all, I have a very very remedial sheet of, my expenses. But what does that need to look like for you and for tax purposes from the US side? That's a very simplistic question, but
No, I see what you're saying. I mean, and that's what's kind of annoying about the Form 5471 is there's no threshold for size. So like it's the same form and requirements for Google's billion-dollar subsidiary in the UK as it is for you. So I mean, technically we need a profit and loss statement and balance sheet. Now, like in your scenario, I can help you come up with that. So if you give me the expenses and the income, I can help build that a simplistic financial statement that for purposes of this. As you start to grow, it may be important for you to get a real bookkeeper, get that set up too, or at least get, and maybe it's not even a bad idea now, to get set up in something like QuickBooks or FreshBooks, just because it's really easy. I mean, you plug your bank account into it and it can spit out, a profit and loss and balance sheet. It can, and as you get more transactions, it can get complicated, but that would kind of be my suggestion for now. I think FreshBooks, you can do it for free. There's another one called, I used to use this right when I started my business. It was called, I'll send it over to you because they're pretty good. Oh, it's called Wave, WAVE. But they have a free app they do pretty good. And it also offers invoicing and things through it.
I have Zoho. Have you used Zoho? Is that an American thing at all? Yeah. So I have access to Zoho. Should I just be doing it there then?
Well, Zoho is that's like a sales CRM. I've only used their sales CRM. I've never used their financial CRM.
Yeah, they do. Yeah, they have a whole financial suite, and then they do invoices, and yeah.
Yeah, but for this year, you can just send me your expenses, and that's not a problem.
But yeah, I appreciate having these conversations now. I know that I'm a small case, and I'm not really earning much, but I want to be setting this up and going through the motions. Yeah. I want to have the long-term vision in place.
No, sounds good. Yeah, do you have any other specific questions on this?
Just the whole FEIE versus FCT thing. It sounds like FCT just isn't something I need to be pursuing because I'm living in the UAE, or is that a conversation we need to have?
Yeah, good point. I did kind of skip over that because you're in the UAE and there's not a personal tax. It's really not going to be applicable to you. But one thing I know, the UAE started a corporate tax. That's one thing that we'll need to look at for the LLC that you set up there, but I'm pretty sure it's kind of the same thing. If you're paying it out as a salary, there's really not any income there for them to tax. And I mean, right now you're in a loss anyway, so it's kind of irrelevant. But there is a difference there. Like the flow through scenario, you would get, if you did pay corporate tax in Dubai, you would get a credit for that on your U.S. return. Whereas in the corporate scenario, it's more complicated as to how we get there. But again, I think the plan would be to manage the profitability of the UAE company anyway through salary payments. But yeah, that'd be something we could look at. But yeah, in your case, as far as personal foreign tax credit, it's really not going to be relevant. That was definitely a thing when you were in Germany. Because in Europe, generally, I go with the foreign tax credit instead of the foreign earned income exclusion. Not always. always, but sometimes just because there's certain things, the foreign earned income exclusion, taking it prohibits you from. Like child tax credits can be a
I've been going
problem,
through.
like contributing to things like U.S. retirement accounts because you're wiping out your earned income. So it's a either or. You don't get
whole,
you can, like exclude the income you're getting a credit for, but
Like
in your case,
FCT.
it'd be the exclusion.
I think for the purposes of this call, I think we're good. That covers a lot.
If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.
Personal tax, it's really not going to be applicable to you. But one thing I know the UAE started a corporate tax. That's one thing that we'll need to look at for the LLC that you set up there, but I'm pretty sure it's kind of the same thing. If you're paying it out as a salary, there's really not any income there for them to tax. And I mean, right now you're in a loss anyway, so it's kind of irrelevant. But there is a difference there. Like the flow through scenario, you would get, if you did pay corporate tax in Dubai, you would get a credit for that on your U.S. return. Whereas in the corporate scenario, it's more complicated as to how we get there. But again, I think the plan would be to manage the profitability of the UAE company anyway through salary payments. But yeah, that'd be something we could look at. But yeah, in your case, as far as like personal foreign tax credit, it's really not going to be relevant. That was definitely a thing when you were in Germany, because in Europe, generally, I go with the foreign tax credit instead of the foreign earned income exclusion. Not always, but sometimes just because there's certain things, the foreign earned income exclusion, taking it prohibits you from. Like child tax credits can be a problem, like contributing to things like U.S. retirement accounts because you're wiping out your earned income. So it's a either or. You can't like exclude the income you're getting a credit for. But yeah, in your case, it'd be the exclusion.
I think for the purposes of this call, I think we're good. That covers a lot.
If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.